breakout record. In the opening hour and a half or so, it looks like we were going to be off to the races. Then all of a sudden, after reaching that record, we have since come down, barely changed on the day. What to make of that, of course, this is a time where a lot of traders are trying to reassess what happens next month with the Federal Reserve. Most everyone agrees that a rate cut is coming. What we don't know is how big a rate cut it will be. Kindly enough, Thomas Hayes to answer some of those questions. Brilliant young man, the chairman and the managing member, Great Hill Capital. Thomas, great to see you. I'm going to get a twofer with you today, so I'm excited. Let me ask you a little bit about how the market is digesting all of this news on the Fed, then, of course, the attention on Nvidia. We've got a lot going on this week.
Yeah, I think Friday at Jackson Hole, that confirmed a regime change. So with the Fed cutting, different groups in the stock market are going to be able to outperform. For example, small caps, the first 12 months after the first cut, they tend to outperform large caps by 11 full percentage points. Why? Because most small caps have leverage on their balance sheet, and when they can refinance at lower rates, they have a higher propensity to survive.
But they outperform by that much? How far does this go back?
This goes back to 1955.
Get out of town.
Yeah, it's wild.
Right.
And then on the
But haven't they had there was this transition going on?
Yeah.
So that it's going to go even beyond that.
Yeah, it started in July, and then it cooled off with the yen carry trade unwind for 24 hours. But it's interesting. The Fed said they're going to cut. So now Bank of Japan, what did they say? Now we can start to raise again. So you're going to see groups like small caps start to outperform. You're going to see international stocks start to outperform as the yen carry trade unwinds. The dollar weakening, rates coming down. Dividend payers start to outperform. So
what if the yen becomes the world's premier currency in this interim? How does that affect us? Wouldn't that be good for U.S. multinationals and their stocks in an environment like that?
Yes, U.S. multinationals will do well. It won't become the premier currency because their demographics don't support it, but it could strengthen relative to the dollar in the near term. We saw a similar situation in the early 2000s. If you remember, emerging markets were out, small caps were out, and then all of a sudden, from 2002 to 2007, you had one of the biggest rallies in history in emerging markets, in small caps, actually in value over growth. We had that concentration of tech going into that. So I don't think tech is going to crash. I just think they're going to underperform because their earnings growth is decelerating from 30% this year to 18% next year, while the unmagnificent 493, they went from...
I like that. We have the Magnificent 7 and the unmagnificent, but they could be a little bit more magnificent now, right?
That's right. They're going from negative earnings growth. They just inflected to positive earnings growth. That is going to continue into 2025. So you can see with the weighting of tech, the indices are a little bit more subdued, but under the surface, there's a tremendous amount of money to be made in individual high-quality companies that are temporarily marked down.
Now, Nvidia, I think, reports Wednesday at the closing bell. And normally it's been a good trade to buy up ahead of an earnings announcement because it does very well right afterwards. I don't know how long that's held, to be honest. What do you expect this time?
I'll tell you, it's priced for perfection. I think that they'll probably have good earnings, but the analysts are saying they got to beat revenue by $2 billion in order to move the needle. They've got to raise guidance by at least $2 billion. People are a little worried about the Blackwell delay, the new chip delay by 3 months. They want some guidance on that. But if you step back, I'm old school. I was always taught if you buy high-quality assets when they're at reasonable valuations, good things tend to happen over time. This is trading at 29 times sales, $3.2 trillion valuation. Just to put that in perspective, our entire GDP is $25 trillion. Nvidia is $3.2 trillion.
So the upside potential, in your eyes, is limited here.
It's a little more
limited. But what about those who are existing Nvidia shareholders and have been riding this wave? Would you tell them to cash out, parse some of the shares?
Look, you will have time, okay? So even if the report came in poorly, I don't know that it will, because we did see from the hyperscalers a lot of demand for spend. I think what we're also seeing is margins are declining for the Magnificent 7 because of all of that spend. And at some point, like you remember Mark Zuckerberg with Meta, he said, I'm going to invest all this money in the metaverse. And then all of a sudden the shareholders said, we don't like that. And they took the stock down below $100. All of a sudden he says, you know what? I'm no longer going to invest that much in the metaverse, and the stock went back up. I think we're seeing a similar situation.
But he's actually one of the star performers of the metaverse.
Yeah, because he stopped all the spend on Meta. And I think investors are starting to ask, where's the return on investment for all this AI spend on Nvidia chips? And that's not a today story, but as margins decelerate a couple quarters out, and I think the market's starting to see that, we could see a situation where the spend for Nvidia chips slows down and more competition comes up for the GPU chips from other companies.
Real quickly on the political race and how that's factoring in, normally gets to be a big issue after Labor Day in October.
Yeah.
We were getting a lot of machinations much earlier this year. I don't know if that has anything to do with the race, but what do you think?
Okay. Election year seasonality, going back to World War II, we see strength on average through early to mid-September. This year, that happens to coincide with the first cut, which historically, it's sell the first cut. So you have the election year seasonality, which gets a little choppy in late September, early October, and sell the first cut. So we think we'll cruise along here for a few weeks. Maybe we'll get to new highs across the board, and then get a little conservative before the election. And I think year-end rally after the election.
Hang on to that brilliant thought, because I do want to pursue this election thing with you, because there's a raging debate going, who takes credit when the markets go up, who gets it when it goes down. More with Thomas Hayes in just a second. We were mentioning this presidential race and where it sorts out. We're getting indications right. All right, T here, Donald Trump. Let markets go up. It's because of him. When they go down, it's because of the other guy or gal. Bottom line is, it's not quite that black and white. But back with Thomas Hayes on what factors the markets could be looking for. And you were raising something interesting during the break. It's not about who's at the top when it comes to the White House, but the makeup of Washington. Explain.
Empirically, if you look back throughout history, the stock market performs best when one party does not have the executive, the Senate, and the House. So what the markets really want to see is gridlock, and what that is a check on power. In simple terms, the less the politicians can do, the better it is for the markets. Let the markets be free, let business be free, and that will power things through, and the stock market performs best in those environments.
Now, I was looking into a little bit of the history on this. It's ideal if it's a Democrat in the White House and the House and/or Senate are under Republican control, or both. It has happened. That was an ideal environment under Bill Clinton.
Yep.
How do you see it going now, and what would be the ideal environment now?
Well, that is true empirically. Some of that was demographically based. But if I was going to write a book on how to cause a Great Depression, the first chapter would be entitled, Start Taxing Unrealized Capital Gains. I mean, you can't make this up. Who thinks of this, that you would run on that platform? So the number one thing that we want to...
You're talking about Kamala Harris's plan.
Kamala Harris's plan.
Right.
Like, you can't imagine. You have one candidate that's pro-business. You have one candidate that's pro-government. Just taking aside the politics out of it, just from an economic standpoint, the platforms of what's going to be better for employment, what's going to be better for the economy. I mean, if you started taxing unrealized capital gains and people grasping for liquidity, it would be the quickest way to a Great Depression.
Normally, you tax your capital gains once the trade is commenced and all of that. But if this would be, obviously, people would be less inclined to get in the markets. Now, Democrats could come back and say, well, that's not our cup of tea. We don't like the markets. But it's interesting you chose that issue rather than her wanting to raise the corporate tax rate to 28%.
Well, we've been there.
We've been there is right.
We've been there, the corporate tax.
And a lot higher. We were at 35.
Look, I mean, let's be fair. Some people like to borrow and spend politicians. Some people like to tax and spend politicians. The key is all politicians like to spend. That's how they retain their power. So that's a risk. But in terms of the market, in terms of corporate tax rates, it still has to get through Congress. So they've got to have a grand slam, Senate, House, and executive branch to push that through. So the market's kind of like, okay, 28%, you're not going to get it. Even if you're elected, as long as there are checks and balances, the markets and the economy will be okay.
What do you think? I've talked to a lot of people from the markets, Tom, who say Donald Trump is far more market-friendly, issues-wise, than he was as a president than Joe Biden or what we hear out of Kamala Harris. But their big pause is he's crazy. And he'll do crazy things, and that will defeat all the other good stuff he's doing. And that gives them their trepidation. Is that justified?
Okay, this is hysterical. So when Trump was elected, everyone said, energy stocks are going to do incredible, China stocks are going to collapse, and solar stocks are going to collapse. The exact opposite happened.
That's right.
Energy stocks dramatically underperformed under Trump. They did well under Biden. China had one of its biggest rallies during the Trump administration, and solar stocks did well. What's happened under Biden? Energy stocks have done well. Chinese stocks have collapsed. They thought he would be weak on China. He was tougher on China. Trump just wanted to do a deal with China. He said, we're going to tariff you 60%, and then he brings them to the table. They cut a deal. He wants to make money. He wants to do business. He wants to create jobs for Americans.
So the obvious quid pro quos don't always pan out. Just like under Barack Obama, the drug makers and the big pharmaceutical companies would tank. They soared under him. So it sometimes goes against pattern. How do you see it going if Donald Trump were to return?
Well, I think the Trump trade would be back. I think what we saw after he was elected, 2016, you saw small caps start to outperform. You saw industrials outperform. The market started to price in a better tax environment, which increases earnings. Look, if you move the corporate tax rate up to 28%, that's going to have an impact on earnings per share. So then if you don't get multiple expansion, you're going to have the market stalling on the basis of lower earnings. So I think that initially, the market will like the idea also of no wars. Under the Trump administration, there were no real geopolitical wars. It was relatively peaceful geopolitical environment. You don't have to worry. Right now, we've got kind of two.
So they'd lose sight of some of the crazier features. In the case of Kamala Harris, they would dread some of that. But again, if she's held in check by a Republican Congress, House or Senate, it's another game, right?
Yeah, look, at the end of the day, earnings power is strong. We have projections of 15% earnings growth next year. That's likely going to come around in the ballpark, irrespective of who's elected.
Is that right?
The key is going to be the policies moving forward and then the outlook moving forward on the basis of those policies. So if you could say, if you have pro-business policies, then 2026 looks a lot better than pro-government policies. 2026 maybe starts to look a little bit worse, depending who's elected, in which case the market will begin to price that after the election. But on balance, given the seasonality of election years, as we touched on, I think a little choppiness in October, and we probably will get a year-end rally just because of the underlying strength. And more likely than not, whoever's elected, we're going to wind up with gridlock, and that's a good thing for the stock market.
Well, watch closely. Tom, great catching up with you. Thomas Hayes, following all of that. One thing we left out with Tom is real estate.